Good morning, students. In today's video lesson, we are going to learn the subjective. We are going to learn marginal costing. That is subject of marginal managerial costing. This is the subject of sixth semester students. So, through this video lesson, what we are going to learn, let us see. So, in marginal costing, we are going to learn absorption costing. What are the advantages and the limitations? After that, we have one more method, that is marginal costing. These are the two methods, absorption costing and marginal costing. These two methods are there. So absorption costing is traditional method and the marginal costing is a latest method. So some difference is there. So let us see in marginal costing what is the need of marginal costing, and what is the meaning of marginal cost, what is the meaning of marginal costing, and the features, what are the features consisting marginal costing. So these are the learning outcomes through this video lesson. So let us continue this video lesson. So marginal costing, in that traditional method is absorption costing. In this absorption costing, how this is how we are taking cost, how we are classifying the cost, how we are calculating the cost. So let us see, if absorption costing is followed, then how we are going to ascertain the profit. So let us see in this method through this pro forma. So this is income statement. This is income statement. So under income statement, first we have to take, this is vertical format. Under income statement, sales we have to take first. After that, whatever the cost of goods sold are there, that is to be deducted from these sales. Then in cost of goods sold, we have direct materials, labor, factory overheads, and if any other expenses uh, on production basis, if we have this expenditure, this expenditure comes under cost of goods sold. These cost of goods sold is to be deducted from sales. Then again we have to add, if any opening stock value is there, that is to be added. Why? Because this is opening stock value is belongs to last year closing stock, last year's value. So this last year value is brought forward to the present year, that is current year. That's why we have to add this opening stock. Then if any closing stock is there during this year, that closing stock is to be carried forward to the next year. So that's why this closing stock is to be deducted. So later we will take, and if any under absorption or over absorption of factory overheads are there, that is to be taken into consideration, that is to be added. So then ultimately we get gross profit. After that, from from gross profit, we have to deduct administrative, selling and distribution expenses. In that we have two types of uh, cost, that is fixed cost and variable cost. So these two types of types of cost are to be deducted from gross profit. Then ultimately we get a net profit. So what I want to say in this to throw this pro forma. So in absorption costing, there is no variation of fixed cost and variable cost, and in marginal cost we will show the variation of fixed cost and variable cost. In absorption costing, there is no differentiation between these two costs. Both the costs, whatever the cost is incurred, those costs is to be taken into consideration. That's why these two costs are to be considered as cost. So that may be fixed cost, that may be variable cost. So uh, so what is fixed cost? What is variable cost? That is also we have to know. So when volume of production is increased, volume of production is decreased, volume of, there is no production, then there is no cost. So variable cost is depends upon volume of production. If volume of production is increased, variable expenditure is increased. If volume of production is decreased, variable cost is decreased. If there is no production, there is no value, then there is no variable cost. So that's why uh, variable cost is uh, depends upon volume of production. So that's why if the production is increased or sales is increased, cost may be increased. That is variable cost. So about fixed cost, there is no change. There is no dependence on volume of production. So if there is production, production is increased, this production is not increased, there is no production, but we have to pay the cost. That is fixed cost. So when time comes, the cost is to be paid. So that's why expenditure cost is to be paid. That is fixed cost. It is fixed for forever. So that's why fixed cost is to be paid when time comes. So there is no deviations. But when variable cost, if the production is increased, the cost may be increased. If there is production, then only variable cost is there. So that's why in absorption costing, there is no deviation between these fixed cost and variable cost. The total cost is to be taken into consideration. That is absorption costing. So under absorption costing, like this, we have to calculate these profit and loss. So let us see one problem under this absorption costing. So we have given information regarding to XYZ company. Normal capacity is 40,000 units per month, and the variable cost per unit is 6 rupees, and the actual production is 44,000 units. Actual production is for 44,000 units. This is more than the normal capacity. Okay. Now sales 40,000 units. That is 15 rupees per unit is sold out, and the fixed manufacturing overheads 1 lakh per month or 2 rupees 50 paisa per unit at a normal capacity. Other fixed expenses 2 lakhs 40,000 per month. Okay. Prepare income statement under this absorption costing. So this is the information regarding to income statement. So with this information, we have to prepare income statement. How much profit we are going to get through this information that we have to calculate. Uh, so let us see sales. Whenever we are preparing income statement in vertical, uh, whenever we are preparing income statement, that should be in vertical manner. It will be easy to compare from the previous years. So that's why income statement should be prepared in vertical format. So let us take first sales. So sales are 40,000 units. That is 15 per unit. So you see sales is 6 lakhs. Okay. From that we have to deduct cost of goods sold. Just now we discussed. So cost of goods are to be deducted. So that's why cost of goods sold. So in that what we have materials we have. So 44,000 units are produced. The capacity is 40,000 units, but actually produced 44,000 units. So each unit consisting 6 rupees per unit. So that's why variable cost per unit 6 rupees 44,000 units. Then 2,64,000 rupees is variable cost. So fixed manufacturing overheads, that is 1 lakh. So that is to be taken into here. And then closing inventory. Is there any closing inventory? Yes, we have inventory. So 4,000 rupees additional closing inventory. So that's why 4,000 by 44,000, then we get 34,000. So for 33 lakh 74,000, uh, how much we are going to get excess? So that will be closing inventory. So that's why a closing inventory will be calculated like this. So for 40,000, there should be 4,000. Then how much it will be for 3 lakh 74,000? That is 3 lakh 34,000 is calculated like this. Then same uh, absorption or absorption of fixed manufacturing overheads, that is 1 lakh 10,000, because 1 lakh. So then over absorption is 10,000, that is to be deducted. Then ultimately we get 3 lakhs 30,000. So now we are getting gross profit. Gross profit is 2 lakhs 70,000. Other fixed expenses, that is 2,40,000 just per month. So that's why net income is 30,000. Net income is 30,000. So like this, absorption costing, we have to calculate profit or loss. Okay. Then what are the advantages are there through this absorption costing that we will discuss. It suitably recognizes the importance of including fixed manufacturing cost in production cost determination and framing a suitable pricing policy. In fact, all cost means the total fixed and variable included related to production should be charged to units manufactured. Price based on absorption costing ensures that all costs are covered. Prices are well regulated where full cost is the basis. So whatever the fixed cost is there, whatever the variable cost is there, the total cost is uh, considered here in absorption costing. There is no deviation. There is no deviation. Both the costs will be recognized equally. So that's why that is the advantages. There is no variation. It will show correct profit calculation in case where production is done to have sales in future. It may be seen as compared to the variable costing. So whenever you are comparing to variable cost means is nothing but marginal costing. So when we are comparing variable costing, correct calculation of profit can be shown when production is done in future. So in future also how much expenditure can be uh, production cost is there, how much variable cost is there, how much fixed cost is there, that can be known in future. Whatever the present cost is there, the same cost will be happen in future also. So that's why there is there is no difference between present and future cost. So that's why uh, that can be known. Uh, Correct profit calculation can be known, and it helps to confirm with accrual and matching concepts with required matching cost with the revenue for a particular period. It has been recognized by various bodies as USA, UK, and India for the purpose of preparing external reports and for valuation of inventory. So it is recognized by the uh, boards, some boards, that is USA board and United Kingdom board and India board. Accounting standard boards are recognized by by to this method. So for external reports, we have to prepare these reports. So to prepare these reports for external purpose, the boards are accepted, and it avoids the separation of cost into fixed and variable elements, which cannot be done easily and accurately. Of course, sometimes we may not segregate the fixed cost and variable cost. Uh, Fixed cost and variable cost we may not segregate accurately. So that's why that is a good method. So the total, whatever the cost is there, that is to be taken into consideration. Okay. Next, it discloses inefficient or inefficient utilization of production resources by indicating under absorption or over absorption of factory overheads. So what are the factory overheads are that can be known if there is any inefficiency or efficient utilization are there, that can be known through this method. It helps to make the managers more responsible for the cost and the services provided to the uh, centers, departments due to correct allocation and apportionment of fixed factory overheads. So the allocation of fixed and variable cost can be apportioned by the centers, departments, so easily. So so that's why more responsible to the managers. So that can be easily apportioned and allocated to the concerned departments. Next, it helps to calculate the gross profit and the net profit separately in income statement. Of course, in this method, we may calculate net profit, what is net profit, what is gross profit through this income statement easily. So that's why this method is very useful uh, mm, to production units. So that's why it is followed. course, let us, whatever the method is there, we have two, for a coin, we have two sides. In the same way, if you take any method, there will be advantages and limitations. So that's why let us see one side of advantages, one side of angle we have seen, but the other side of the angle of absorption costing we have to see. So limitations of absorption costing. So let us see difficulty in comparison and control of cost. Difficulty in comparison and control cost. Absorption costing is dependent on level of output. So different units cost are obtained for different levels of output. An increase in the volume of output normally results in reduced unit cost and reduction in output results. An increased cost per unit due to extension of fixed expenses. This makes comparison and control of cost difficult. So here both the costs are included. So it is very difficult to control fixed cost or variable cost, and it is very difficult to compare which cost is to be more, which cost is to be less. So that's why to control the cost is most important in production units. So it is very difficult to control the cost in this method. Next, not helpful in managerial decisions. Yes, absorption costing is not very helpful in taking managerial decisions, such as selection of suitable product mix, whether to buy or manufacture, whether to accept the export order or not, choice of alternatives, the minimum price to be fixed during the depression, number of units to be sold to earn a desired profit, etc. So, what we are discussing here, the method, absorption method is not useful to make decisions. Why? Because both the costs are included. Both the costs are included. There is no separation of fixed cost and variable cost. Fixed cost is fixed. When time comes, the cost is to be paid. What about variable cost? If production increased, the cost increased. If there is no production, there is no cost. So that's why according to the selection of the products, according to the make and buy decisions, that only the cost may vary. So that's why we cannot we cannot sum up with fixed cost. So that's why sometimes may not be useful to the management to take better decisions because it is included both the cost. So that's why may not be useful. Next, cost vitiated because of fixed cost included in inventory valuation. Under absorption costing, a portion of factory fixed overhead cost is carried forward to the next period because closing stock is valued at the cost of production, which is inclusive of fixed cost. So that's why fixed cost included in inventory valuation. So that's why cost may vary from the other when we see with comparing variable cost. Of course, variable cost may be less, but fixed cost is more. Then the total cost can be known. So that's why next we see a fixed cost inclusion in cost not justified. Many accountants argue that fixed manufacturing, administrative and selling distribution overheads are period cost and do not produce future benefits and therefore should not be included in the cost of product. So fixed cost may not give any justification. So how the justification is not given. So sometimes administrative expenses may be there. Administrative expenses, some of the expenses may have fixed, some of the expenses may not have. So some expenses may be planned, some expenses may not be planned. So like that, in selling and distribution also, we may have planning and non-planning expenses. So that's why how we have taken these fixed costs included with the uh, total cost. So it is not justified. So actual cost is to be taken into consideration. So if product to determine price of the product, whatever the cost is incurred, that is to be taken into consideration. Then ultimately, consumer will get benefited. Okay, so that's why that is a problem. So apportionment of fixed overheads on arbitrary method. So the validity of product product cost under this technique depends on correct apportionment of overhead cost. But in practice, many overhead costs are apportioned by using arbitrary methods, which ultimately make the product cost inaccurate and unreliable. So apportionment of fixed overheads that can be done arbitrary method. What is the method of this is apportionment of cost. Apportionment of cost may be followed some method using arbitrary method. Method is nothing but so equally distribution is done. Equal distribution will be done uh, continuously to all departments. Of course, some departments may not involve in that expenditure, but how we are allocating that expenditure. So arbitrary method is may not be suitable to allocate this expenditure. So that's why all the departments may not give equal expenses, equal cost. So that's why that is the problem. So it is unreliable and inaccurate method to follow arbitrary method. Okay. Next, not helpful for preparation of flexible budget. So under absorption costing, no distinction is made between the fixed and variable cost. It is not possible to prepare fixed flexible budget without making this distinction. So that's why it is not helpful to prepare flexible budgets. So that is a problem. Okay. So with this, we discussed about absorption costing. So what is the thing is this is a traditional method, whatever the method we followed from so far years. So this is absorption method, and at this method there is no difference between fixed cost and variable cost. Both the costs will be given equal importance. That's why in total cost we have to add both the cost. Of course, maybe separation is there, but not given any importance to one cost and another cost. So that's why that will be the problem. So that's why, of course, ultimately we can get gross profit and net profit. Ultimately we can get, but the problem is there is no deviation. Of course, sometimes one expenditure may be more, one expenditure may be less. So that's why whenever we compare with fixed cost, variable cost with fixed cost, then variable cost is less sometimes. Variable cost is more sometimes. So that's why it is not a suggestible method. So that's why that is the limitation of absorption costing. Of course, that was the traditional method. That's why we followed. Now the new method, and this method, what is the purpose? What is the need on this marginal costing? Because limitations of absorption costing, drawbacks of absorption costing, the new method came into picture. That is marginal costing. So in this marginal costing, what we have that we discussed, that we discussed. So need for marginal costing. Fixed expenses remain constant in aggregate amount and do not vary with the increase or decrease in production up to a particular level of output. Yes, definitely. Just contrary to this, variable expenses increase or decrease in production to increase or decrease in output and remain constant per unit of output. Fixed expenses per unit continue to vary with the increase or decrease in production because these expenses remain constant up to a certain level of production. Thus, fixed overheads lead to different costs per unit at different levels of production. On account of these, a special technique known as marginal costing has been developed for which excludes fixed overheads entirely from cost of production and gives us the same cost per unit up to a particular level of output. Thus, under this technique, fixed expenses are not allocated to cost units but are charged against fund which arises out of excess of selling price or total variable cost. So now we see fixed expenses will be incurred up to some level of output. There is no change. If some level of output is increased, then cost may be increased. So up to some extent, fixed cost is fixed. So there is no variation in fixed cost up to some level of production. Then what is the use of fixed cost is to be included every time in the total cost. So that's why the total cost may be increased. So that's why up to some level of extent, the production fixed cost is fixed. There is no use of fixed cost. So that is fixed. If there is no production, there is no increase, there is no decrease of production. It will be fixed. So that's why the problem is there. What is the difference is there? A variable cost is a matter. Variable cost is a uh, um, thing is to be considered. Variable cost is to be considered. So that's why variable cost, volume of production is increased, it is increased. Volume of production is decreased. So that's why if the price of the product depends upon the whatever the cost is incurred for such product. So that's why uh, this marginal cost is required. So that's why importance is given more than the uh, importance is given to marginal costing than the absorption costing. So in this method, fixed cost is fixed for up to some level of output. So that's why there is no change at all. So where we are taking decisions, we have to take decisions based on variable cost because a level of fixed cost is fixed. So that's why how we are taking we are taking decisions. We are taking we are taken into consideration uh, uh, this fixed cost for decisions. So that's why whenever we are taking decisions, fixed cost is not considered, only variable cost is considered. So that's why marginal cost is taken into consideration. So what is the meaning of marginal cost? What does it mean? So the Chartered Institute of Management Accountants London defines the marginal cost like this. So marginal cost, the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. In this context, a unit may be a single article, a batch of articles, an order, a stage of production capacity, or a department. It relates to the change in output in the particular circumstances under consideration. So that's why at a given volume of output, uh, the aggregation of cost may be changed. It may be increased, it may be decreased. So what is to be incurred? What is to be incurred? The additional cost by increasing additional 1 unit or decreasing additional 1 unit. So that effect is to be studied. That effect is to be known by the management, by the decision makers. So that's why if 1 unit is to be additionally produced, then how much cost is to be increased? If 1 unit is decreased, how much cost is going to be decreased? That is to be known by the management. So that cost, whatever the cost is going to increase and whatever the cost is going to decrease, that cost is known as marginal cost. Let us take example here. One we see example. Variable cost per unit is 10 rupees and the fixed expenses for 1,50,000 per annum and output of 30,000 units per annum results the following expenditure. So variable cost 30,000 units, 10 rupees, that is 3 lakhs. Okay, fixed cost is 1,50,000. So now the total cost is 4,50,000. So this is the total cost of that concern. If output is increased by 1 unit, the following expenditure will be incurred. So you see variable cost, if 1 unit increased, 3 lakhs 10 rupees, 3 lakhs 10 rupees. Fixed cost, there is no change. Fixed cost, there is no change. So that's why total cost increased by 10 rupees. Now total cost for 30,000 units is 4 lakhs 50,000. Now marginal cost per unit is 10 rupees. So what do you say? So if one unit is increased, 10 rupees is to be increased. If one unit is decreased, 10 rupees going to be decreased. So that's why now uh, decision makers will take decisions based on this. So fixed cost, there is no change. Fixed cost, there is no change if 30,000 units are produced or 30,001 unit is produced or 29,999 units are produced. There is no change at all. Fixed cost never change. So that's why fixed cost is fixed. So that's why what is going to be changed? Variable cost is going to be changed. So that's why variable cost is to be variable cost is to be taken into consideration for the decision making. So that's why uh, marginal cost is the variable cost. It is also known as direct cost or volume cost or activity cost. So let us see marginal costing. You have to know. So now we know what is the marginal cost. If additional unit is produced, then whatever the cost is to be incurred, that cost is to be known as marginal cost. Now, how we are going to calculate this marginal cost? So it is a process. So that's why let us see, according to uh, Chartered Institute of Management accountants terminology, marginal costing is the ascertainment of marginal cost and of the effect on profit of changes in value or type of output by differentiating between fixed cost and variable cost. In these techniques of costing, which represents management to the required information, enabling it to measure profitability of an undertaking by considering behavior of cost. It is it is not a distinct method of ascertainment of cost, such as process or job costing, but a technique in which only variable costs are charged to operations. Process Processes are products leaving all indirect costs to be written off against profits in the period in which they arise. It is clear from the above that only variable cost from part of product cost in the technique of marginal costing, because only variable costs are charged if output is increased or decreased and fixed costs remain the same. So that's why while calculating marginal cost, there is fixed cost remain fixed. So that's why marginal costing is a different from direct costing. Direct costing is the practice of charging all direct costs to operations, processor, or products, leaving all indirect costs to be written off against profit in the period in which they arise. Thus, in direct costing, some fixed cost could be considered to be direct cost in appropriate circumstances, but fixed cost is never taken into in managerial cost. So that's why. So this is marginal costing. So let us see what are the features consisting this marginal costing. So what features consisting this one? So let us see the, the features are. It is a technique of costing which is used to ascertain the marginal cost and to know the impact of variable costs on the volume of output. Uh, it is a technique that we know. So uh, absorption costing is a method and margin costing is a method. So this marginal cost is uh, taken because of variable cost may affect the volume of production. So that's why that is a feature. So if volume of production is increased, variable cost may be increased. So that's why it impacts variable cost. So that's why that is a feature of marginal cost. All costs are classified into fixed and variable costs on the basis of variability. Even semi-fixed is segregated into fixed and variable cost. Yes. So the classification, when we take classification of cost, fixed cost, variable cost, and the mixed cost. In mixed cost, we have fixed cost and variable cost. So that's why, uh, yes. So that's why uh, all the segregations are possible. So if fixed cost is there, variable cost is there. So that's why there is no problem at all. So that's why uh, variable cost can be calculated easily. The separation of fixed cost. So let's see one more. Variable cost alone are charged to production. So yes, fixed costs are recovered from contribution. Yes, fixed costs are recovered from contribution. Variable costs charged to production. So that's why it can be easily identified. Next, fixed costs are written off and charged to statement of profit and loss for the period during which they are incurred. So for which period fixed cost is written. So that's why with this profit and loss account also we get. So what is fixed and what is variable. So next one, valuation of stock of work in progress and finished goods is done on the basis of marginal cost, on the basis of on the basis of marginal cost, uh, in valuation of stock of work in progress and the finished goods are calculated. Next, the selling price is based on marginal cost plus the contribution. Yes, in selling price also, variable cost can be what we say, selling the difference between variable cost and selling price will be contribution, or we can say variable cost plus contribution can be known as selling price. Yes, the profit is calculated by deducting marginal cost and fixed cost from sales. Yes, definitely. So first we are deducting uh, variable cost, then deducting fixed cost, then ultimately profit can be calculated, or we can be known loss. So it may be profit, it may be loss. So cost value profit, or we can say break-even analysis, is one of the integral part of margin costing. So break-even analysis, this is a position where we are getting no loss and no gain. Sorry, no loss and no profit. No loss and no profit. So that's why it is a position to be known by the decision makers. What position we are going to get, uh, the profits are going to be started. So that's why cost value profit is to be is a part of marginal costing. The profitability of product department is based on contribution made available by each department. So that's why profit can be calculated for each department, each product based on the contribution. So that is also possible in marginal costing. And the next we see it involves the techniques of both cost recording and cost reporting. So it is possible in both. So two aspects which require detailed treatment. These are ascertainment of marginal cost, cost to value profit that will be break-even analysis that will be discussed in further uh, classes. So we see ascertainment of marginal cost. How do we get marginal cost? Marginal cost is different from total or absorption cost. In marginal cost it is assumed that the difference between the aggregate sales value and the aggregate marginal cost of the output sold provides funds to beat the fixed cost and profit of the firm. In respect of each product, the difference between its sales value and the marginal cost is known contribution. Uh, this contribution is the difference between the sales value and the margin cost of the sales, and it contributes towards fixed expenses and this one. So contribution is to be calculated with the help of the difference between selling price and the marginal cost, or we can say fixed expenses, fixed cost, profit is to be added to fixed expenses, or we can say a loss deductible from the fixed expenses. In that way also we can say. So that's why contribution minus fixed expenses will be profit or loss. So that can be calculated through this margin cost easily. Okay, it can be calculated easily. So with the marginal costing is only. Uh, so with this, we are concluding this session. Uh, so in this video lesson, we learn what is absorption costing, what are the advantages, what are the disadvantages we have, and what is marginal cost, and how we are going to calculate this marginal cost, and how do we get contribution. So like this, in this video lesson we learned. So it is concluded in this video lesson, and in next video lesson the topic is continued, and how we are going to consider marginal cost to take decisions. So that's why it is closed now. Thank you, thank you, thank you, one and all.